Hi, welcome to our show today, folks. We got a great show lined up for you. We're going to be talking about initial public offerings, or what we call IPOs, the need for life insurance, some reasons why you might want it, the U.S. dollar index, why do we follow that, safe withdrawal rates, what does that have to do when it comes to income planning, and then Medicare, Medigap, the supplemental insurance, what does that look like? So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, in this segment, I want to talk to you about initial public offerings, or what we call IPOs. Listen, this is simply a private company, all right, privately held stock that now wants to go public. Now they call this going public, right? And so there's a process that happens with these IPOs. First of all, that private company has to sell it to an investment bank because they want somebody to underwrite it. All right, that means put all the proper disclosures together so they can go out and solicit interest from other investment banks, okay? So what's happening in this process is they're going out and they're selling the idea, they're soliciting interest from other investment banks saying, listen, are you interested in so many shares, at maybe a certain price? And there's this kind of supply and demand process that kind of happens in this behind the scenes. Now, why does a private company do this? Well, what they're doing it for is they're seeking to go public so they can have access to a large pool of investment dollars, okay? Before they had to peddle that kind of on their own, but now when it goes public, they got a large pool. Now, why do they want a large pool of assets? Well, maybe to pay debt. Maybe it's just working capital. Maybe it's money that they need to grow to the next level. Now, it also helps them if they go public. They might go for initial public offering because they need so many shares for growth, but what about growth down the road? Then they can issue more shares as it goes along. So you got this investment bank that's out there trying to solicit for interest from these other investment banks, and they call this basically the book building process, okay? And again, the supply and demand thing is happening behind the scenes, with these investment banks as far as how much they want to buy and what they're willing to buy it for. And then you have what's called the day of the IPO. Okay, this is what you hear on the news. This initial public offering is going to come out, and this is where you get a lot of hoopla, right? Because if this company has any kind of branding, you may be interested in getting on this in the early stages, right? So there's this book building process that happened, but now on the day of the IPO, there's more book building process going on, all right? Maybe some of those investment bankers see some excitement out there, maybe they want more shares, so that kind of happens a little bit during the day. And then it comes to a point where when that supply demand hits and they have enough shares they think is going to come out, now it goes public. And this is where everybody tries to jump in. Now, you got to remember with IPOs, there's some disadvantages, right? Now this company that was private is now publicly accountable. and as far as disclosure goes, they have to have prospectuses. And these things are very costly to form, but usually the benefits outweigh the cost because of the things I talked about earlier. So hopefully this gave you value. Maybe you see these IPOs come out and wondered what the process was. Thought you might want to know. At Centennial Wealth Advisory, we specialize in retirement planning. Folks, we put a show together every week that we talk about a number of financial topics that are critical in your retirement planning, from tax planning, estate planning, income planning, long-term care, health care planning, and investment management. If you missed the show, then you just visit our website, go to the media tab, and you'll see the latest show. In this segment, I want to talk about life insurance. Now, when I was a young man, had not accumulated a lot of assets, I had 3 kids at home, and I was the sole breadwinner, I found having life insurance very, very important. But as I got older, as I acquired some assets, my kids are now grown up, they're having their own kids now. Did I find that life insurance was as valuable as it was when I was younger? Maybe not. But I want to give you some ideas where life insurance can be valuable in retirement planning, especially in the latter years. First of all, when it comes to life insurance, a lot of people will be paying this premium, and they'll coming in and they're saying, Larry, I'm not seeing much value in maybe having this. I'm paying this premium. Maybe we could have that being going to something different, And what I'll ask them is simply this, what do you need that life insurance for? Is there any need for it at all? Because when you're looking at life insurance, you have to look at it like any other kind of insurance. I have house insurance in case my house goes on fire and I lose it, right? I'm going to want that contingency taken care of. I get long-term care insurance because if I fear I might go into a nursing home, I want to make sure I have the insurance for that. I have car insurance in case I have an accident. I have life insurance in case something happened to me. Does my family need any lump sum of money in any way? I want to assess it simply that way. If I have sufficient assets and I don't really need that anymore, then I would dare say we probably don't need to pay the premiums on it. There's some areas where you might need it. If maybe one of the spouses has a pension and is going to lose some of that pension amount, all or some, if something happened to that spouse, then, or maybe with Social Security you're going to lose the lesser of the two, having a lump sum to replace that income could be important in those latter years if we thought that could happen. We can use life insurance in an IRA exit strategy. Let's say I've got a big lump sum of IRA money, and I'm in such a tax bracket that I can't buy out Uncle Sam while we're both living. But what if that first spouse dies and the second spouse, the surviving spouse, has this lump sum money from life insurance that they can use to buy out Uncle Sam out of the IRA and then forever have tax-free income from then on? That could potentially be valuable. Again, any time I could see where I might need a lump sum of cash for any reason upon my death, then I'm going to want that life insurance. Now, you may not know this, but a lot of life insurance today, the death benefit can now be used for long-term care. So sometimes if you still find life insurance valuable and you want it, you might be apt to maybe want to get some recent quotes because that death benefit can be used for that long-term care. Could be valuable. So hopefully this gives you some ideas where life insurance can be used in your retirement planning. Hopefully you found it valuable.
Wow, two very, very interesting topics there. IPOs and life insurance. John, if you spend too much time following IPOs, you might need life insurance. But guess what? IPOs are some of those things out there that are really attractive for a lot of people because they're exciting, they're new, there's a lot of hoopla around them, and the stock prices can go crazy usually for a few days. You think back to last year, you had DoorDash, you had Airbnb, a few years before that, I think it was like Beyond Meat was this crazy thing. And so there's all these different names that we hear a lot about in the news, or these up and coming companies, and then they come out and go public, and it generates a lot of buzz. And sometimes behind the scenes you can get early purchases and that sort of stuff. But boy, be awful careful with this sort of stuff. As you can imagine, I'm sure you've seen some of this stuff move. There's all these risks that can be associated with these new companies and rising and falling stock. The volatility can be crazy. And if you don't properly plan and have a place for that in your retirement portfolio, it can really hurt you and devastate your long-term plan.
Yeah, and just like Art's talking about there, as far as looking at your overall portfolio, life insurance is a topic that I know it seems like anytime we bring it up, people say, oh no, a lot of times I'm too old for life insurance and everything. But again, it's just another tool that you might look at in your retirement plan. You think of, there's been cases where we've seen where years ago somebody may have taken with their pension an option where husband and wife, and they basically said, well, we're just going to take no survivorship benefits, but we're going to go and buy some life insurance. Well, turns out, Art, when they did that years ago, they selected a term type of life insurance policy that only lasted about 15 years. So here they were in their mid-70s, and now there was only no survivorship benefits on the pension, and meanwhile they no longer had that life insurance. So when you're looking at that later on, it's important to consider what length of time are you looking for, and is it some type of lifetime benefit that you want? And along with that, nowadays sometimes there's benefits that could help pay for some type of long-term care assistance. So there's a lot of different things to be looking at if that's something that's important to you.
You know, I think the key takeaway there is, John, don't just quickly discount life insurance. It is not for everybody, but guess what? There's so many different versions out there and so many different ways it may be appropriate for you. It isn't so much the preconceived notion that it's just to provide for lost income is one of them, but there's so many other things, as John talked about, taxes, providing for estates, all that sort of stuff. So if you have additional questions, give us a call to the number on the screen. Stay tuned because we have a couple of more exciting topics coming up here on Retiring Well.
Christ Hope is a ministry that works in 7 countries in sub-Saharan Africa. We're focused on AIDS-affected, orphan and vulnerable kids. And the first time I went to Africa, I remember holding a little boy named Joma. And Joma was 5 years old. He had AIDS. He had open sores in his mouth. He was skin and bones. He was lethargic. And they didn't know if he was going to make it. And so Joma, thank God, has been able to get better because of drugs and ARVs. And even though we've come a long way in helping AIDS, it's still a huge issue. But children like Joma are vulnerable to being pushed off into orphanages and neglected and trafficked. And so we come in to help children like Joma be able to stay in families through the support that we do. And we moved in 2010 to a family-based preservation model. And we've seen a dynamic change and transformation in kids who are able to grow up in families versus institutional care.
Dave, I just want to thank you for Christ Hope. It's had a personal impact on my life. You attended our church, I think it was like 9-10 years ago, and you had all these little cards of these kids that we could sponsor. Out of that whole group of kids, I picked one child, and her name is Antonia Anthony Meadows. She was in the 4th grade. She just entered your program. I can't help every child in Africa, but I've been able to help one. And now since then, my wife has joined on and we're now supporting 2 new ones. So it's been very rewarding, and again, just want to thank you for all you do.
Thank you. And so our children now, the first children, Larry sponsors one of the children that was part of that. Antonia, she was able to live with her family, and she's graduating from high school in October, and she'll be exiting the program and going on to university. And she's a great testimony of the impact of this ministry, helping children to be not just healthy physically and academically and spiritually, but emotionally, is that they really grow because they have family. They're not orphans anymore. They have families, and they live in families. Yeah, and I just really want to thank Centennial Wealth. Thank you so much for believing in us and being a partner with us and supporting us in this. This is huge and has a great impact directly to the kids in our program. So thank you.
I want to talk to you about the dollar index. Now, this is an index that was created in 1973. What they basically did is took our currency, compared it with the other world currencies, and they baselined it at 100. And then we've been basically tracking it ever since. Now, sometimes it can be up, sometimes it's down. I think at the end of 2019, it was somewhere around 96, 97. What was that saying? Basically saying that our currency relative to the other world currencies was just about the same as it was back in 1973. Now, why is this something that we follow? First of all, when we got a strong dollar, which should be a good thing, right? But when we have a strong dollar, it makes our exports more costly, which hurts our manufacturing. All right, now how's this work, you say? Well, if you've ever traveled abroad, maybe it's Mexico, maybe it's Canada, you'll notice that if our currency relative to that currency, that foreign country you're entering into is stronger or better than their currency, then you get great purchasing power because you get bigger bang for your buck per se, and it makes what you're buying less money. So that's a good thing when you got a strong dollar and you're spending it abroad. But what it does, a strong dollar, like I said, is makes our exports more costly. You'll find if the other currency from the foreign country that's importing goods, they have a competitive advantage because their goods coming into our country are now less expensive. All right, so this again hurts our manufacturing. Now, manufacturing makes up a good 10% of our GDP, so this is something that we want to follow very, very carefully. Now, the other thing that you want to pay attention to when we're looking at the dollar index and why we care about how strong the dollar is all commodities are traded in U.S. dollars. So you'll find that when the dollar is starting to weaken, commodity prices will rise. This is something we definitely want to pay attention to. Now, you'll hear a lot of news, about China and the trade war we find ourselves in and how they're manipulating their currency. That's because Chinese government is in a lot of the public-private enterprises in the country. So they also have the ability to manipulate their own currency. So it gives them a highly competitive advantage when they can play games with their own currency, bringing it down, making their imports into our country less expensive. It kind of gives them a competitive advantage that we don't like them to have. So hopefully this kind of gives you an idea why this is something that we want to follow, why we want to pay attention to it. Hopefully you found some value in it.
We look forward to helping you plan to retire well.
I want to talk in this segment about what we call the safe withdrawal rate, okay? Now, what this is the concept is simply this. It's an amount or percentage of a portfolio that you can take from that is considered safe in the sense that you're not going to run out of money. You might even grow your principal a little bit over time. Okay, so it's not brain surgery, all right? If I got a portfolio that's making 5, 6, 7% on average, and I'm pulling 4, 5% out, maybe that's what I've deemed a safe withdrawal rate, then that works all day long, right? Because I got 5, 6, 7% pulling 4 or 5% out. That plan's going to work forever, right? Now, that's the concept, but you have to understand, you're going to want to make sure that you don't have any big losses in that picture. Remember, that concept only works if you're averaging that as a rate of return with no hiccups. Now, let me give you a case where this can be bad. Let's say I got a portfolio that's maybe, let's say just $500,000, just so we use a round number, and I'm pulling 5% off. So now I'm taking $25,000 a year for income, okay? As long as that portfolio continues to make 5% or more, I'm good, right? But what if we have like a 2008 and that portfolio drops to half its value? If I needed that $25,000 for income and now my account's only worth $250,000 and I'm pulling out $25,000, folks, you're now pulling out 10%. Now, how do I grow it back? I've got to get a better than 10% rate of return from here on out just to even start building that portfolio back up. So you want to understand that that concept works, but you're not going to have any big losses. It used to be that when you got close to retirement or in retirement, you were in what you call the preservation of wealth and income phase of your life. Most would just move from equities into fixed income accounts like bonds when they were paying, let's say, 5, 6, 7% or more. Today, the yield on bonds is so low, it's hard to make that move without having a mix of stocks in there. And of course, with stocks or equities, there's risk. So you want to be well diversified, you want to be positioned accordingly. Be careful of those income plans out there. There's a lot of income plans. All advisors have the tools. They'll tell you that you're never going to run out, but remember that one assumption is that rate of return they put in there, that growth rate is going to be consistent, and sometimes that doesn't happen. All right, remember in retirement, your number one enemy is going to be volatility, as I explained earlier, so be careful.
Really great topics that Larry's bringing to our attention here. And with that U.S. dollar index, the big thing that comes to mind is inflation, especially as you're getting close to or into retirement and you're trying to figure out that long-term income plan and what that looks like, maybe how much money your portfolio is going to need to generate. You've got to factor inflation into that, and that $5,000 a month that you're spending today, what does that look like when you're 75, 85, 90 years old? So those are key things, as well as then that safe withdrawal rate, how it's changed over the years. We look back when bonds were paying a lot higher interest rate, you could maybe more consistently count on a set income stream, but now you're having to look at other options, right, Art?
I think that's absolutely right, John. And what we're talking about here, that safe withdrawal rate. So many people have these 401k accounts, IRA accounts, and they see that balance and they just take money out of it. There really is no plan. And when you talk about these withdrawal rates, with all these challenges that we face today, I mean, goodness, probably, John, like our grandparents, when they retired, they put money in a CD and they were making 8-10% back then. But guess what? That's not available today. And so we have to look at other options, and you have to have a very detailed income plan. And John, and one things that we like to do here, and for some folks, is we talk about bucketing, having these different strategies of maybe some in more of a safer, more conservative route, and then some out in growth. And so when you're looking at where to take income from, it can potentially help you in those volatile times and not have to reduce your income payments. John, there's probably not a conversation I never want to have, but to call somebody up and say, hey, the markets aren't performing, guess what? We can't send you your paycheck this month, right?
Right. You want to be confident in what your long-term income plan, and make sure that you have a good holistic plan set up for your retirement. So stay tuned. We've got a lot more coming up here on Retiring Well.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply schedule a meeting at one of our Northern Michigan office locations for a free, no-obligation retirement review.
All right, in this segment, we want to talk about Medicare. Now, believe it or not, when you turn age 65, the whole world knows about it. And in that year, you're going to get inundated with all kinds of mail. You may even have people showing up at your doorstep to talk about Medicare. But what is happening here? Well, with Medicare, you qualify at age 65, and you get what's called Part A and Part B. Now, Part A is simply hospitalization coverage. Part B is outpatient coverage. Now, you have to understand with Medicare, it's going to cover about 80% of the cost. But there's gaps in the coverage. We'll call that just, the 20%. And if I want to get those gaps covered, I'm going to have what's called a supplemental plan. Okay, something that's just going to come alongside Medicare Part A and B, and it's going to fill all those gaps so that I can have closer to 100% coverage, okay? Now, what a lot of people don't understand is there's two different routes you can go. Okay, one route you can go for supplemental insurance is what we call the Medigap route. Okay, now this is government regulated. There's a number of different plans. They go from A to Z. And some are in force, some are not in force, some come and go. But you have to understand, with all these plans, they're all regulated. So for example, if I have a Medigap Plan K, then that's going to be the same for everybody. There's going to be no difference. So it's a lot simpler in that regard because I know what my coverage is going to be. Now, one of the disadvantages to having a Medigap plan is that I have to get what's called prescription drug, or what they call Part D, has to be a separate plan. Okay, it's not included in my Medigap plan. The other thing that's not going to be included in my Medigap plan is maybe dental insurance. If that's something I want, then that's going to have to be a different plan. Now, one of the other disadvantages with a Medigap plan is, although they're all regulated, they have to be the same. No insurance company has to charge the same price. So this is something that on a periodic basis you're going to want to get shopped, because if I've got Part K, let's say I got a Medigap Plan K with one insurance company, but with another insurance company, the same exact plan might be cheaper, then I'm going to want to know that, right? So a lot of people, they get their plan, and then they never look at it again. And this is really something that, you know, every so often should be shopped. No different than your home insurance or your car insurance, to see if maybe you can get a cheaper amount. Now here at Centennial Wealth, we actually do this for our clients. So, you know, they'll come in with their plan, we'll shop it for them, we'll show them where the best rates are. So if that's somebody like you and you haven't had somebody look at that in a while, then you're going to want to give us a call. Now, the other route you can go is what's called the Advantage Plan route. Okay? Now again, this is just supplemental insurance. Now why they call them an Advantage Plan is simply this. It has all of these. It has eye and dental, it has prescription, all rolled into one plan. But the disadvantage is it's not regulated. They don't have to be the same. So I can have one Advantage Plan with one insurance company and have another one with another insurance company, and they're going to be completely different. This kind of goes back to when we used to have to shop our health insurance, right? You know, Blue Cross's plan might not be the same as Priority's. And so we had to compare those plans to see, not only from a cost standpoint, but we had to see what the coverage was to see which one kind of made the best sense for us. So you got these two different ways to go, and what's best for you is going to be determined on what kind of coverage you want. You know, if you're going to be a traveler, you're going to be somebody maybe traveling around, and you want out of state health insurance coverage, maybe another doctor's plan, then depending on what route you go, that could be a big difference. What if I'm somebody that travels out of country? You know, what kind of a plan do I want that might cover that? So a lot of it is going to be based on your lifestyle, but it's something that you want to be able to check into. So I encourage you, if you're somebody that's got a plan out there, hasn't been looked at in some time, and you think maybe you might be somebody that might be able to save some dollars, then give us a call. We'd be glad to give you a quote.
Well, a little change of pace there. Larry just got into health insurance and Medicare. Boy, what a thing that at some point we're all going to come in contact with and have a chance to look at those options. And for those of you that have already got all the flyers in the mail and all that sort of stuff that comes to you, you're probably not surprised by this. But it's interesting kind of how you'll have these two paths. But the one thing as a financial advisor, what I think about when we come to this is just the general concept of the overall plan. Once again, it kind of all comes back to this holistic approach. We talk a lot about this, and you may be thinking, how does Medicare play a role in that? Well, guess what? Even though Medicare isn't income driven like the pricing of like the marketplace type insurance is once you get to 65, if you have too much income, you're going to have to pay an IRMA penalty when you get into taxes. So when we're doing tax planning with IRAs and non-qualified accounts, that may play a role. And for those of you out there that are watching the show that you've ever had to pay that additional cost of Medicare because you've had too much income, that one there seems to hurt more than just an increase in tax. You know, I've had folks, they just be so frustrated about that penalty that they almost become paralyzed by it. So it's interesting, John.
Yeah, and that's where we've got a couple of different team members here at our office that specialize in this area in assisting you to understand both the Advantage side, the supplemental side, and a lot of different moving parts. One of the things that I found really interesting is that these are designated plans on the supplemental side that the government has set up, and so they're the same, but each company can offer it at a different price, and a lot of times people get a little bit surprised. Oh, we've been with this company for a couple of years and we really like them, but hey, there may be a lower cost option out there for you. So again, as you're looking at your retirement planning, we encourage you to give us a call or visit us online at cen-wealth.com. Thanks again for tuning in to Retiring Well.